Harris is now joining us. He's Chief Executive at Port Shelter Investment Management. Richard, good to have you with us here. Good morning. Thanks very much for your time. Yesterday was a bumper day for the market here, Richard. We had a 2% rally on the Nifty. The banks index went up some 3.5%. It hit an all-time high. I think from a global perspective as well, after the commentary from Fed Chair Powell on Friday, I think there is the expectation that rate hikes are done. That is reinforced, doubly reinforced. Things looking set for more on the upside for equities, global equities, Richard?
Well, I think what's happened is that we've had a situation where equities actually have done extremely well. And, India's performance yesterday is an example to that. I think actually what we've done is we've borrowed some performance from the future. Yes, we are likely to see a decline in interest rates. I think the markets will be disappointed because it won't be as much as people would think, but I think we are likely to see a decline in interest rates. We're also likely to see a decline in economic growth, which has been, pretty good globally. And I think those two will largely balance themselves out to have maybe a rather tepid start to the year. So basically what we've seen recently, I think, is performance that we've borrowed maybe from first quarter next year.
So you're saying we may perhaps not get the number of rate cuts from the Federal Reserve as the market is hoping for. So can you tell us what is your own expectation and how will the market read it?
Yes, well, let's take what the market's general view is at the moment, just looking at how derivatives are performing. The market's generally looking at 25 basis point rate cuts next year. So that's 1.25%. Now, Fed funds are currently at 5.3%, thereabouts. So we're really looking at interest rates by the end of next year being 4%. Well, the market's, I don't think, is really looking at that. I think it's expecting a lot more. And I think interest rates at 4%, maybe with a slowdown in the economies and slightly less confidence, will probably be about right. But I think what we have to say is that, a fall down to 4% isn't exactly a long way. We're not that long ago. We were looking at 1 or 2% in the market. So we are going to be in an environment where interest rates will remain relatively high. And I think markets will be disappointed like that, but probably not until maybe halfway through the first quarter.
Hi, Richard. Good morning. Nigel on this side. Richard, normally when you join in, I ask you what's, whether or not flows will move to China, but you've pretty much cleared it, that India's preference, top of the list. And it appears now, more than China plus one, investors could be looking at as India is the only one. Maybe I'm running a little ahead of myself, but we have lower crude and a stable reformist government. It's a perfect recipe for Nifty to scale even higher from here.
Well, Nigel, the thing about you is that you always remember what I said previously, which is always very worrying for a commentator. But yes, I think that's right. I think China is obviously going through some very difficult times at the moment. What we saw was a slowdown in COVID. It has actually led to some quite worrying issues in terms of both corporate and household debt. I've no doubt that China will work its way through the bottom of this. The authorities tend to look at the economy quite strictly, and they will come through and start, I think, to reflate the economy in the new year. But in the meantime, obviously, India is a bit of a winner out of that in terms of maybe some investment in China moving towards India rather than China. We've seen Apple coming in. And yes, if you're looking at some of the positive signs in the economies at the moment, of course, not if you're a farmer, but we're seeing foodstuffs fall in price. You've seen oil fall in price. There's a lot of deflation and disinflation around the world, a lot of it emanating from China. And that actually has been quite good for economies such as the US and Europe, which normally, I think, would experience quite high inflation at this time. But we're seeing disinflation in other areas of the market. So US is still the Goldilocks economy. We've got quite strong growth. It's not causing inflation because we've got deflation elsewhere. And interest rates look as if they've topped and maybe start to come off the top. So you can see why November was so good. But again, I think some of that performance has been borrowed from the future.
All right, Richard, we'll leave it there. Thank you very much for your time. It's a pleasure having you with us here on CNBC-TV18. Thank you.